Welcome back to the Keiser Report. I'm Max Keiser. Time now to turn to Simon Rose of SaveOurSavers.co.uk. Simon Rose, welcome to Keiser Report.
Thank you very much, Max.
All right, this is really fantastic. We've been talking about it all show. Since the crisis began, tell us how much wealth has been redistributed from British savers to the debtors, the bankers, the speculators.
Well, we reckon, given that there's about £1.1 trillion worth of savings in the UK, that you're talking of something of the order of about £102 billion, which would pay for the Olympics 10 times over.
Every time Mervyn King opens his mouth and talks about quantitative easing, what he's saying is he wants to take more money out of the pensioners' pockets and savers' pockets and give it to the debtors, right?
Yes, he's slightly more subtle about what he wants to do. Charlie, being the deputy governor, is less subtle. He keeps saying savers should stop whinging and just go out and get spending. But, you know, frankly, if you spent your life trying to put a bit of money by for your old age, that is not really the message you want to hear from the Bank of England.
Right. It's also you go bankrupt with that kind of thinking. Now, who devised this redistributive policy? Where does it come from? What quango thought of this god-awful mess?
Well, who thought of anything? I mean, essentially, you know, we were used to an economy that worked when the base rate was actually above inflation. And that went with one tiny exception from the late 50s through to the crisis hitting. That is how things worked. And suddenly, when the crisis hits, they slam base rates down to 0.5%, but instead of doing it as an emergency measure, which we were told it was, they've just kept it there.
Right. People use this term financial repression, meaning that the bank is involved in an institutionalized form of repression by keeping rates. It's artificially low. This quantitative easing is not the natural rates would be if the bank simply got out of the way.
Yeah, absolutely. And you know, we grumble because we represent savers, and savers are having a terrible time of it. Some people who've got mortgages say, well, I'm all right. That's fine, but it has such a massive effect. You know, money has a price the same as anything else. And if you suppress the price of money, then it sends out all the wrong signals. The economy does not work. We've seen that 3 years of virtually zero interest rates, and it is gumming up the economy. What happens is that the banks can't actually function in the normal way, so they take greater risks. Savers who can't actually get a decent rate of return, they might take greater risks. The whole economy does not work if you have interest rates at this level. What is the bank doing suppressing them like this? Surely we're supposed to be living in a free market economy, and what is happening is they're just decapitalizing the country.
Now, you mentioned homeowners there, and going back to the origins of this whole mess, you know, the 2007-2008 period, there was the subprime crisis in the States, and of course here you had the collapse of Northern Rock, and there was huge crisis, if not bankruptcy, Bradford and Bingley, and they were offering these 120% mortgages.
Liar loans.
The liar loans, but the 120% mortgages, they were offering bigger loans than the underlying value of the house, even when the value was cooked by the appraisers. They came in with fraudulent appraised values. And it sounds like that's what they want to go back to.
Well, they wouldn't argue that's what they want to go back to at all. The problem is we're so heavily indebted as a country that they've got no option. They've painted themselves into a corner. When I bought my first place, 2.5 times salary is what you were allowed. And that seemed to work fairly well. And then somehow through the first 10 years of this century, somehow borrowing for all manner of things just became acceptable. And we're now floating on a sea of debt in this country. It is quite extraordinary. It's not just that saving has been undermined, it's that the debt has escalated out of control. I know not only in the UK, but it is extraordinary. And what's more, we now have these pathetic, pettifogging arguments between politicians about whether we should have growth or austerity. I mean, that's not what the argument should be about. The argument should be about looking at actually the level of debt in the UK. We had our Deputy Prime Minister, a man called Nick Clegg, the other day actually saying that in the next 6 or 7 years what they were doing was getting rid of the debt because we had to have a clean slate for our children and our children's children. And you think, when the Deputy Prime Minister of the country can't tell the difference between the deficit and the debt, that really shows perhaps why we're in such an appalling mess. It's a difference that even the Chancellor of the Exchequer got wrong a couple of times in the budget.
But there is a sector in the economy that benefits from creating trillions of debt. And that, of course, is this banking sector that seems to have incredible leverage and lobbying influence in governments around the world, including this government. And they're not crying that the debt levels are exploding because they make money processing, creating this debt, and dealing with the servicing of this debt. And there is this idea of what's called a fire economy. Fire, insurance, and real estate. We talked about the mortgage market. We talked about the subprime. We talked about Bradford and Bingley going bankrupt. So this is all part and parcel of this fire economy that's all based on securitization of assets like mortgages to create them into tradable securities, and it all ends up going into the City of London, and it squeezes out. Am I right in saying, Simon Rose, that this squeezes out to some degree, or perhaps a very large degree, other productive aspects of the economy? Your thoughts?
Yeah, I used to think, I confess, that people attacking the banks was a little unfair, but they're not particularly productive. I mean, £325 billion of quantitative easing, where's it gone? It's just sitting in the banks. It's not being used for anything useful. I can remember when banks had essentially two roles. They would help people with their household finances, and they would support companies. They would help them raise money. They would help them buy other companies. What is all the rest of it for?
Let me jump in right quick here, because this notion, you hear it in this country a lot in the media, banker bashing, that it's unfair, there's too much of it, and there's a lot of character assassination. I know I engage in it myself all the time. But Simon Rose, let's break it down as economists. It's not about character assassination and ad hominem attacks and banker bashing. It's the fact that you've got this one sector of the economy that's growing like a cancer, at a rate of cancer, but and the word you use, it's not productive. It doesn't add anything to the underlying fabric of the economy that's sustainable and productive. It's just paper pushing. Is that a fair?
Yeah, and it was just totally dependent on debt. The moment that debt, the extra money stops being produced, they're in deep trouble. The Bank of England actually brought out a report, which I suspect that Mervyn King probably didn't see before it went out the door, or he probably would have stopped it, saying that in fact by bailing out the banks, what we are doing is setting ourselves up for an even bigger collapse to come, and that the implicit subsidy to the banks of being bailed out is worth £220 billion over 2 years, and they're paying themselves much more in terms of profits and pay as a result. Well, when even the Bank of England realizes that what has happened is absolutely appalling, then you know really everything you have been saying about them, frankly, is true.
Well, that's, Mervyn King, he is kind of an interesting figure, because he, unlike Ben Bernanke, who's obviously drunk the Kool-Aid, who has no wavering doubt about his certainty in matters of monetary policy, Mervyn King seems to make some statements where he has some doubt about all of this fiddling going on. But does he have any power ultimately, or does he defer to the IMF? Because this is, or other world organizations, other banking. It seems like there's a lot of power now with the IMF, World Bank, these other global banking institutions, the Bank of International Settlements, the BIS, who are really calling the shots more and more. Here we have Mervyn King seemingly deferring to some greater authority. Is that, what's going on there?
Well, I'm not sure. He would argue, of course, that he doesn't. I mean, he heads our own monetary policy committee, which is tasked with ensuring the stability of the pound.
But he signs off on QE.
Yeah, absolutely.
But he knows it's inherently bad for the country.
Well, does he know? Well, there are two problems. Either he knows, in which case he shouldn't be doing, or he doesn't know, in which case he probably shouldn't be the governor of the Bank of England.
So he's just equivocating.
Well, yeah, and he claims, and I think you've probably heard this speech he made recently, in which he basically claimed nothing was to do with him at all. It wasn't his fault. The fact that he presided over a very lax monetary policy while the bubbles were building seems apparently to have escaped his attention entirely. But, the MPC's been going for 15 years. They've been told to keep inflation to 2% by successive chancellors. And over that time, the RPI, the measure of inflation that most people would use, not the one, of course, the government now uses, has gone up by 53%. But a lot of staples, the things that, we're concerned of, because a lot of savers, particularly people who are pensioners, things they have to buy, things like eggs and flour and petrol and coal and that sort of thing. A lot of things have doubled in price in just 15 years. So the main reason for the MPC, which is to keep, our currency at a sensible level and not to let it be undermined completely. It's just they failed entirely.
MPC, Monetary Policy Committee.
Yeah, oh yes, I'm sorry.
So similar to FOMC in the US.
Nine men, usually men good and true, almost all academic economists, most of them with no experience of the real world at all, and all macroeconomists, all.
Central planners.
Yeah. Absolutely.
In a purportedly capitalist.
Well, exactly, yes.
Free market economy.
Who have kept base rates at 0.5% since March 2009.
Now, you bring this interesting point that you've got two dueling economic forces. You've got the price of stuff that people are buying at the shops is going up rapidly. But you've got house prices are still, in other portions of the economy, the bond market and other areas like Greece, et cetera, experiencing deflation, you could call it. They're exploding. So you have these two forces in the economy. Let me ask you this. Is it because we're seeing something that we haven't seen before, which is an organic kind of growth of policies that have gone out of control, or have our financial engineers that have been so active re-architecting this economy invented a way to keep asset prices higher without ever seeing labor costs rise?
Well, certainly at the moment. I mean, cost of wages is rising much less than the price of inflation. It's why most normal people who don't work in the city in this country are feeling poorer all the time, and why everybody's so depressed.
How did they manage to do that, to get asset prices to go high and keep the cost of labor, down here? Is that by design or by default?
I don't think they're clever enough. I think by design, no, not at all. But it's very simple. If you start producing extra money, where does it go? It goes into the city. By the time it gets down to the lower levels to you and me, prices have already gone up.
Okay, you say it goes into the city, but the banks in the city are now majority owned by the taxpayer. How are they able to hold on to that cash?
But the taxpayers are not seeing much benefit from that.
Right.
I mean, interventions have cost something like £1.3 billion. Are we ever going to see any of that back? No. Does that sit on the government's balance sheet? Are they actually declaring that as being a part of their debt? No, of course they're not. Just like they're not declaring any of the future liabilities as being debt. It's like they're pretending the debt is not there at all. But it's crazy. The problem is that we have not actually corrected anything that was wrong before we went into this crisis.
So
we bailed out the banks.
It's a Christmas pantomime.
It's
Mervyn
not very
King.
funny. Mervyn King. What, you think he's the pantomime horse? Which end, the front or the back?
I leave that up to you to decide. Simon Rose, we're out of time. Thanks for being on the Keiser Report. All right, and that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacey Herbert. I want to thank my guest, Simon Rose of Save Our Savers. If you want to send me an email, please do so at keiserreport@rttv.ru. Until next time, Max Keiser saying bye, y'all.